Markets have experienced one of their most volatile weeks, given the issues that really are coming from all sides. We start with Europe, and this week we had a European summit. The key here is that over the course of the next 3 weeks, I suspect these markets are going to be continuing the volatility ahead of the Greek election. We know that in the very near term we have issues such as the election that could have quite wide ramifications for markets going forward, and therefore I think that for most market participants, they're retreating to the sides at the moment, heading off, continuing into the safe havens, and therefore the volatility we're seeing at the moment is being driven more by traders than I think investors. This I think will continue until we get some further news out on the Greek elections and what implications that will have for Europe going forward. One area that has come under some severe weakness this week has been the currency of the euro. This chart shows a 2-year picture now of the euro, and we can see that the euro found a 2-year low this week at around 125. This is a trade where many investors have been short of the euro. I think we're at record levels, and indeed it's a trade that's probably taken some time to begin to unwind. But I think that what investors are focusing on here is the dynamics of trying to deal with Greece, trying to keep it within the Europe, what this is going to mean, how they're going to do it. Ultimately somebody will have to pay, and it's the route that they have to pay that clearly concerns European investors. The subject of Eurobonds was raised this week, and we heard that a large number of members of Europe voted in favour of Eurobonds. The guessing is that those that didn't vote in favour are the ones that will ultimately have to pick up the bill, and so this is just goes to the heart of the diversions within Europe and how they resolve some of these issues. So the euro weakness has been quite a feature of this week. The second chart I want to pull up is a very short-dated chart, but really looks at the stock market of the FTSE 100, but only for this week. And it's just been fascinating really to see how quickly the markets have sort of hit the lows, bounced back up to 5,400, and it's done that on 2 or 3 occasions within the short space of a week. So it's really just highlighting how difficult these markets are to navigate in the very near term, and just be aware of that, particularly while these uncertainties are around. If one market that certainly hasn't rallied at all during that period, whilst others have, as I say, have expressed some bounce. This is the Greek stock market. It continues to find new lows despite recoveries elsewhere, and I think it really is the case that looking at the Greek situation, a post-Europe impact, what will this mean for corporates? What will it mean for their contracts that they've signed up in euros? What does it mean for their bank loans, for their cash deposits? The implications are obviously far and wide-reaching, and as I say, markets are very upset and concerned about that particular aspect, and that, as I say, manifests itself in the Greek stock market hitting lows not seen now for over 20 years. Turning back to the UK, I want to take a look at sterling, because the UK had some poor numbers this week. The UK was looking at a second reading for the GDP that is for the first quarter of this year. Now, this reading initially came out at 0.2%. Negative growth for the quarter. The second reading has shown that it's actually 0.3%. So it means that for a second quarter in a row, the UK has continued to show weak negative growth and is technically back in a recession. I think there's a lot of debate at the moment. We're going to hear more and more from politicians, not only here in the UK, talking about growth and as much as austerity, but also in Europe. But I don't think necessarily markets have seen the actual details of how they're going to grow the economies. And I think attention in the UK particularly is going to turn more to 2013. The forecast for growth by the OBR, and these are the numbers that the Chancellor does rely upon when budgeting, is indicating a 2% 2% economic growth for the UK in 2013, and that is a number that is looking scarily high as we enter into the halfway point of 2012. 2013 also will become a very material year for the US. There's increasing talk at the moment that whilst the fixation is in the Eurozone issues, that US next year will have more fiscal cliff, as they refer to it, as many of the tax incentives are taken away and the spending cuts hit into the US economy. So at the moment, everything needs stability, but there are worries about the US side. This chart of the currency really is just showing that money was heading back into the dollar. So we saw euro weakness, but we also saw some sterling weakness hitting during the course of this week. Just one or two stocks I want to mention this morning. The first stock that I have here is Tesco. Just to say that a stock like Tesco is hitting multi-year lows again. Obviously they had a profit warning earlier this year, which caused a very significant decline in its share price. It never really bounced, and what we have seen recently is further drift in the Tesco price, getting down to levels really only seen briefly in the dark days of 2009. That was a very temporary low driven by obviously the post-Lehman effect, so it's an unnatural low, but we're finding our way back there now. I suspect more on fundamentals, and if we do find an area of 280 to 290 again, there will clearly be a much heavier questioning of Tesco and its new strategy. At the moment the share price is not indicating much belief in that strategy, so we do need to keep a fairly close eye on that particular stock.